Oh my goodness, the market has crashed for 3 straight days in a row. Last week was the worst week since COVID for the S&P 500, and this morning, the S&P and the Dow were all down again, with many great American companies like Amazon, Microsoft, Adobe, Oracle, Tesla, even Boeing selling around 20% or more below recent valuations. Wait, 20% off? Kind of like a sale? This sounds like a good thing. Isn't it a buying opportunity? Hey financial warriors, welcome to the show. My name is Ben Hedges, aka the Credit Shifu, and on this channel I cover US credit cards as well as personal finance topics. If you like the sound of that, please subscribe. In this video, I'm going to talk about the recent turmoil in the stock market and why it's actually the best buying opportunity we've had since the COVID crash in 2020. So last Wednesday, President Trump announced his so-called reciprocal tariffs, which, apart from annoying the hell out of China because the tariffs gave the impression that Taiwan is a country, these tariffs also rocked global stock markets. The next day, April 3rd, the Dow was down 1,700 points, and as China retaliated with tariffs against the US on Friday, the markets fell even more. And today, the Dow was down like 900 points before the market opened. Trump is threatening another 50% tariff on China, and media are already reporting on this with big, scary red boxes at the top of their articles and throwing around the word bear market. Which, to be fair, is accurate. If the market falls 10%, that's called a correction, and 20% or more is referred to as a bear market. So why is this happening? Well, obviously the tariffs have caused global panic. I think they ended up being worse than many expected. They're not really reciprocal tariffs, but instead the Trump administration came up with a formula of what they would need to charge in tariffs to achieve trade balance between the US and every other country in the world. I probably wouldn't do a good job of explaining it to you, but there is a great video from Stand Up Math where he explains the formula. I'll paste it somewhere down below. Anyway, these tariffs were pretty high. Okay, you have 34% on Chinese goods, 20% on the EU, and there's a 10% base. Okay, so none of them are lower than 10%. And this led to selling in the stock market. And hedge funds have started getting hit by margin calls, forcing them to sell even more stocks, which has tanked the market even more. Now, if you don't know, margin is where you can borrow money from your brokerage to trade stocks. So for example, I have an account with Charles Schwab. It's one of the biggest brokerages here in the US. And in addition to my stocks and my uninvested cash, they also give me several $1,000s worth of margin that I can trade with as well. Now, obviously, since I'm borrowing money from them, I do have to pay interest on that money. But I do sometimes use their margin feature to take advantage of good buying opportunities like today, and then I pay myself back over the next month or two with just money from my regular income. But in theory, if you're confident that you can get a higher return on stocks that you buy than you are paying in margin interest, it could be in your interest just to keep those margin loans long term and profit the difference between the margin interest and the return on your stocks. And like individual retail investors can take out margin loans, so can hedge funds. The problem with margin is that if you use a lot of margin and then the market falls and the value of your overall portfolio falls as well, you are then not eligible for so much margin. Since brokers use a formula which is basically a percentage to figure out how much margin they will allow you to have based on the value of your account, okay? You can't go below a certain baseline. They start reducing the amount of margin they give you. Thus, they will issue what is called a margin call, where they require you to either deposit more of your own money in the account or sell stocks to pay off the margin loan. Those hedge funds that couldn't deposit more money had to sell stocks, and this then crashes the price of stocks even more since selling action reduces the price of stocks, all right? And that then leads to more margin calls because the value of all their accounts has gone down, and you get this crazy price action that we've seen over the past few days. But knowing this, in a way, the market is kind of now artificially low. It's not based on the fundamentals of companies or the economic outlook at all. And there could be some silver linings. For example, oil is now under $60 a barrel, which reduces the cost of transporting goods and even transporting people on business trips, which is a good thing for pretty much every company in the world. The chance of the Fed cutting rates just increased massively, which will benefit both the US government, who has to refinance a load of debt this year and they don't want to do it at high interest rates. Makes you think Trump may have even been trying to crash the market on purpose, and He's still putting pressure on the Fed to lower rates. We've talked about this in previous videos. But it will also benefit anyone who borrows money, like companies or people buying houses with mortgages. And on top of that, lower rates push the stock market up, since people can't get such a high rate of return in savings accounts and with bonds, so they look to the stock market, and this increases the likelihood of a fast and big recovery. But for now, until that happens, there are currently some great American companies that are selling at a huge discount. Let's go through some of them. Today, I bought shares in tech companies like Adobe, Amazon, Oracle, and even companies like Boeing. They just signed a huge contract for the 6th generation fighter jet, which is a massive contract, okay? The F-35, Lockheed Martin built that, and the whole thing over its life cost $2 trillion, all right? I kid you not, it's a massive amount of money. So it's a truly massive contract if you think that this one will be probably the same size as the F-35 contract, and it's been awarded to Boeing, not Lockheed. Now that value was somewhat priced into the stock already at the time of the announcement in late March, but now Boeing is down with the rest of the market, not really to do with any change in the company's fundamentals, and we can get them at a discount. And this is also the reason why Warren Buffett has been sitting on a $300 billion pile of cash for the past few years, okay? It's been increasing over the past few years, peaking at about 330 billion or so this year. He's been precisely waiting for opportunities like this, where you can pick up stocks in major blue chip companies. Okay, blue chip means companies that are super stable with long histories and aren't going to go bankrupt anytime soon, at discounted prices, and then he'll hold these long term. And maybe you want to go with something really safe, companies like Coca-Cola that's steadily grown for years and years and years and has increased its dividend for years too. Even that has dropped with the whole market, but it's starting to rebound, as have some of the companies that I bought today too. And how bad can this tariff stuff really get? News headlines already say that 50 countries have phoned the US to negotiate new trade deals, and even for the ones that don't manage it or are unwilling, they're going to adjust, okay? Companies will move factories to the US or figure out other ways of doing things. And in a year's time or so, you'll be sitting on stocks that have appreciated massively, and you'll look back at this crash and it'll look exactly the same as the 2020 COVID crash, just a little blip along the way. So my strategy right now is to buy, while keeping some cash on the side in case there are more dips. Remember, Trump has said that tariffs on semiconductors and pharmaceuticals are still to come. That could give us more buying opportunities. And Trump also just threatened a new 50% tariff on China if they don't remove their reciprocal tariff that they added on Friday. So if that really goes into effect, that could cause another massive crash too. So buckle up, guys. And remember, none of this is financial advice. Do your own research, but I view every one of these crashes as a buying opportunity. And if in doubt, just zoom out. Something that looked like a huge crash when it happened in the past, a 20% drop, actually is nothing and really represented a great buying opportunity. And just to illustrate that really well, with a company like Uber, okay, massive company, I bought them back during the pandemic when they crashed down to $15. You look at Uber stock now, it's at $63, okay, that's a 300% return. And I actually just sold my position in Uber literally like 2 to 3 weeks ago. I couldn't have timed it better. Anyway, guys, that is the video for today. If you're in the New York, Western Connecticut, Northern New Jersey, Eastern Pennsylvania area, okay, that tri-state or even quadruple state area, and you want to get away from all the craziness in the stock market, why not have a weekend away at my cabin, okay? There's a hot tub for you to chill out in, you can grill on the barbecue, and you can forget all your worries. Click the link down below to check it out. We got a load of availability this month since it's kind of the shoulder season between the end of winter and spring truly starting. All right, guys, please subscribe to the channel if you're new. We'll see you in the next video. Bye-bye.